Good morning. It is Wednesday, November 5th, 2025. Zach Howard and a market update for this week. Haven't been doing too many as of late, but I want to get back at it. Let's look at, first of all, Canada. Yesterday, the federal government picked up where the baton was passed from the Bank of Canada previously in the week. Easing, accommodating, more fiscal spending is the theme, not just in Canada, not just in the US, or all around the world, especially as real growth slows in most of these Western countries that have been stimulated by fiat spending through the fiscal lens of governments over the last 5 years. The new Mark Carney government, as expected, blows it out with a major deficit spending announced 119 billion in deficits over the next few years, continuous spending, picking up where the Trudeau government let off. This particular budget, though, has more emphasis around capital investment as opposed to social programs. But underneath the surface, it's all the same trade. Quoting Margaret Thatcher, they're on a bit low. The problem with socialism is eventually you run out other people's money. In the projections for the deficit spending going forward, that probably are even more optimistic than they will actually be, is the ability for the Canadian government to borrow at much lower rates than the market is probably going to ascribe to the risk that Canada has going forward. And they're going to borrowing at the short end of the yield curve. It's kind of like the US model. They just keep borrowing at the shorter term of the yield curve, where the Bank of Canada, the central bank, can control rates more. They can control the long end. But the problem with that is the money keeps coming up for renewal. They had to keep refinancing it. None of the government debt ever gets repaid. It's just ability to service the debt. We're looking at here the chart of the Canadian 10-year bond. My question is, do you start to see stress in the longer duration bonds in the government of Canada in this backdrop of a continued fiscal spending around the world? Unlike the US, where people need US dollars to transact, unless you're a Canadian entity or dealing with Canadian entities, do you really need Canadian dollars outside of our territories and provinces? Arguably not. So the relief valve for poor policy decision is often the currency. Looking at the Canadian US dollar cross, 141, how high or does it go? Higher number on this, bearish Canadian dollar relevant to the US dollar, but fiat currencies all relevant gain against each other. Really, if you want to look through the lens of what XAU/CAD, the CAD in gold terms, does over the next 6 months, is more of a tell of how quickly the confidence is being lost in the fiscal policies, in the currency, in the Canadian global financial system. The King dollar, in terms of the DXY, big round number of 100 here now, in the backdrop of yen weaker, continues to break down. The euro continues to break down. British pound continues to break down. A lot of that, though, has to do with the current administration, U.S. government being shut down. What we're basically seeing is a stealth quantitative tightening, because the Treasury in the U.S. has filled up that TGA, the Treasury General Account, put lots of money in there, taking it out of the market, but they haven't able to deploy it back into the system because of the shutdown. So you're having a strain on liquidity that's starting to appear itself here in November. We know that the central bank, the Federal Reserve, has said come December 1st, they were going to enact quantitative easing again, but it's getting late in the game of that, and their hands are kind of tied here until the government shutdown can end. Paper here on the right, back written February 2023 by the St. Louis Fed, saying the Fed doesn't actually know where they need to step into the market and enact the liquidity measures that quantitative easing is. Again, they had projected it would be late 2025 or early 2026 back 2-3 years ago, and here we are at that point. We started to see the cracks in that liquidity system in the U.S. stock market, in U.S. Assets that are super high or beta the last couple of days here. Eventually, this probably gets reversed. Eventually, they end the shutdown, and that money then flows back into the system through government spending, and this short-term spike of volatility goes away. So despite the path of increased cuts around the globe, Bank of Canada, the Fed, etc., the real juice for financial markets is not the policy cuts and rate policy, but the quantitative easing that really gets things going again. 10 trillion in US global, 10 trillion in global government debt to get refinanced during the next 12 months, of that 9 trillion alone in the US. So thus the need for the Bank of Canada, thus the need for the Fed to keep the short duration rates down and keep rolling over that debt. That is the policy stance. Great charts here from Jim Bianco Research showing the stress that's showing off in that liquidity side of the market. People in the market who are looking for liquidity are drawing in on the SOFR overnight rate. End of the month here spikes that we haven't seen for a long time. And this repo facility, boom, a lot of that has to do with some of it has to do with what I just talked about, the TGA, but also you look on here, global systematic banks that have importance on the list of counterparties on that repo facility, the end of October. Those 40 parties, you had a few Canadian banks there, BMO, CIBC, etc. Year ends for Canadian banks were October 31st. So some of that is the TGA, some of it is balance at the liquidity for the Canadian banks. But the takeaway is there is stress in the repo facility market. And ultimately, the Federal Reserve, the Bank of Canada, both will need to continue to support the fiscal spending of the governments in this backdrop. 23% fiscal spending as a percentage of nominal GDP in the US. Haven't seen this outside of COVID and dot-com crash back in the 90s. And the GFC. So still elevated massive spending that is going to need continued support of the central bank, of policy through that quantitative easing method. And with that comes the jazz for more data into financial assets, more returns, and thus ultimately more inflation in the cost of living and financial assets over time. We look at this great correlation chart from Bianca again on Federal Reserve balance sheet. It's been ticking down. Eventually, we know now from the data I just showed, it has to tick back up. And with that, the core CPI will likely follow. The most vulnerable sector to lack of liquidity in the financial system is that crypto market. We've seen the crypto markets peak in 2021 when there was roughly $19 trillion globally that had a negative yielding depth to it. With this lack of liquidity here now and these dynamics, TGA, refill, etc., boom, you're seeing really a lot of stress inside the crypto market, down to 3.1 trillion thereabouts now. Ethereum has a big pullback. Bitcoin kind of trying to hold 100,000, pull back 18%. The last week, 9% of Bitcoin, 16.7% in the higher beta Ethereum, and some of the other altcoins even more pullback on their higher beta. So really, the crypto is a product of a liquidity. Eventually, we know the QE is coming back on. With that, these liquidity names that absorb that, like the altcoins, will probably reinflate. But until that time, still potential under stress. However, the catalyst for an event-driven higher all-time highs again in the S&P, particularly NVIDIA, particularly S&P going towards 7,000, is the buyback window for 85% of the companies in the S&P now starts again on Friday. Easing policy, all that to me says market still goes higher, particularly in the backdrop of NVIDIA getting those passive flows. Year to date, 48%, number one rank in the S&P, and thus continuing to hold a lot of the weight there. Microsoft, Apple, Meta, not so strong as lately. Google does look significantly stronger. Great quote here from a trader. If a position doesn't feel right as soon as you put it on, don't be embarrassed to change your mind. Get it out. Or maybe just start to unwind it slowly over time. Something I've been working on, kind of putting together something of a portfolio that I look at every day and how I track different asset classes, bullish, bearish. Going to continue to work on this. That's what I got for you guys. See you soon. Have a good one.